First of all, thank you for coming to See You at Noon. It's been a real treat. This is the first and most different one from all the others. Instead of it being a little bit Corona-based in response to the market, this is just a topic that's just interesting that really doesn't get discussed a lot. So I figured it'd be a real treat. It does correlate and, have a lot of ripples in the market with Corona. I mean, right now banks are pulling back and, if you're the bank, you don't have to pull back. But we'll get into that in a second. But first of all of our opinions are strictly our own opinions. So it's not KREIA's or anyone else's. So if Luke says something stupid, you can blame Luke for it.
I plan on saying a lot of stupid stuff, so just be ready for it, guys.
Credibility statement. I know you guys don't know Joey. Joey's out of Alabama, correct, Joey?
That's right, Birmingham, Alabama, sweet home.
And I got turned on to Joey, which sounds weird if you think about it.
Whoa, watch it now, Rob. We just met.
I know. This is the first time we're meeting. We talked a little bit. But Luke told me about Brian. Is it Tripp or Tripe?
Tripp.
Yeah. So Brian is in Alabama, and Luke told me a little bit about infinite banking. I think I might have talked to Brian Emerly about it too. And so I reached out to Brian. He's like, "Hey man, you want to come in and do a quarterly investor luncheon?" And he said, "Sure, I've got a book coming out. Like we could kind of coordinate with that." I was like, "Sounds great." Yeah. And then Nick reached out to me, and I sat down with Nick and heard a lot of this, and I was like, "That's cool. I'll read about it. I'll make my buddy Matt Barbier read about it." And then Luke, guys, our Luke has jumped in. He just got his physical. He's going full bore with it. So I think that gives a lot of credibility because we all know Luke is like one of the smartest guys in the room. So
I don't know about that, Rob. Don't come on now.
Smartest redhead in the room for sure. And so
I'm the only one in this room over here with myself right now.
You're not wrong.
I think we can all say that, can't we?
I don't know. But so I think since Luke's buying into it, I think it's all worth all of our time to listen to it. Have an open mind. Honestly, you guys, you Google this on the internet and it's going to get torn apart. And I think it's like your iPhone. I don't know how to use half the things on my iPhone, but I pay the premium to be able to use it. And if you don't know how to use it, you're not going to get the utility from it. And I think a lot of people, it is better to just do term life insurance if you're not going to utilize the components that come with the whole life policy. What time are we at? We are at 12:05. Joey, Nick, why don't you guys start just saying a little bit about you and your background so people can kind of get a feel for you.
Yeah. So I'm born and raised in Louisville. Been a serial entrepreneur for a long time. Made a ton of real estate investing mistakes starting back in 04. Kind of got my clock cleaned after 08. And what I came to learn is that, my mistakes were rooted in not understanding banking. So as kind of came back in 2012, 2013, I was married at the time, working on, making the 4 kids that I have now. And I was really starting to focus, trying to figure out money again. And I would sit down with financial advisors. I sat down with about 6 guys here in town, names that you would know. And I left every one of those meetings going, something doesn't add up. I can't put my finger on it, but something doesn't add up. There's a piece of this I'm missing. And I was working with a guy one night, and he says, have you ever heard of infinite banking? I said no, and I just kept peppering with questions that he couldn't answer. He was just a client of someone else, and he said, listen, just read the book, Becoming Your Own Banker. So I get the book, and I get 25 pages into this 92-page book. It's big font, small words, something even I could understand. And I just said, holy cow, where's this been my whole life? This is talking about the most important business in the world, which is banking. And if I don't understand the banking function, then I'm going to continue to get my clock clean. Doesn't matter what I'm going to go try and invest in. So I actually sought out the author, Nelson Nash. He was 82 or 83 at the time. Unfortunately, he passed away a year ago. But I said, hey, Nelson, nobody's certified in the state of Kentucky to teach this. I'm in. Like, I feel like God put this before me to share with other people, and I want to do that here. And, one thing led to another. And I had reached out. I think we all will really value this piece, is that I really wanted a mentor. It turned out that Nelson gave me one heck of a gift from God. Jim Oliver, my now business partner, is on here too. And Jim reached out to me, that was 5-6 years ago, something like that. We just been working with people this practicing this in my own life has been the biggest impact in my life. It's not, do we make a little money doing this? We do, but it's more about practicing what we preach and helping those that really want to understand how to take back the banking function in their life. So that's what we're about. That's a little bit about me. Joey?
Yeah. So first of all, hats off to Nick and Jim. They're in the Kentucky area. I'm the outsider from Alabama, but just want to encourage again. My story is very similar. I came from a mortgage background. I was in the mortgage business for 11 years. And so I was all around real estate. I am not a gifted real estate investor. Do not ask me any questions like that. That's why you have these guys on the in your area. But I learned the same things Nick was talking about in 2009 and implemented these things, because the thing I kept looking for in the mortgage business was my income was constantly going up and down with market, with rates, with any number of factors that I couldn't control. But I knew that putting money in my 401k or IRAs or things of that nature were just separating me from cash. And I knew there was something wrong, but I didn't know there was anything else. And so in 2010, I started implementing this and made such a drastic difference for my family in 4 years that I had the same sort of kind of realization that Nick had. And it was like, man, the Lord's really just calling me to do this. And so I left a multi-six-figure job at Wells Fargo, leading 25 loan officers, and just started cold turkey in this business. So that's been 10 years ago. My business partner and I started Wealth Without Wall Street. It's a national firm that we also have a podcast, Wealth Without Wall Street. People may have heard, but we're doing the same thing, and we're just consistently spreading this message. I want to encourage you to dig deep, to be open-minded, as Rob said, and don't think of this in place of your real estate investing. Think of it as a way to enhance what you're already doing and to have more control. So I know Nick's going to get into that, and really this is Nick's show. I'm just here to help support, and if there's any sort of questions that I can answer along the way, man, we've got some resources we can help with as well. But I just wanted to be a part of today and continue to spread the message. So thanks for having me on.
Awesome. Well, thanks for going. I think we're at the 12:10. Let's go. Start us off, Nick.
Hey, so here's our disclaimer. I'm not going to give you tax or legal advice. That's not what we do. You know, we can put you in touch with attorneys and CPAs that know what we do. And here's the thing. I'm going to give you kind of a systematic overview of what infinite banking is. This is not geared to get you to do anything other than at the end go, hey, I want to learn more, or hey, cute idea, guys, that's not for me. But and we'll give you, I'm going to talk about this book, Becoming Your Own Banker. I'm happy to give anybody that wants it a copy of that. And we've got tons of resources, like Joe had mentioned. But there's tons of resources out there. So anyway, so we always say, hey, listen, there's all kinds. You're going to see 5,000 ads every day, and they all have one thing in common, and that's to get money to flow towards you instead of to get money to flow away from you instead of towards you. And we're just trying to turn off the noise. Like the financial industry is playing a game so well that we don't even realize there's a game being played. And most people, all of you guys that are real estate investors, you pretty much understand how to play Monopoly, but most people are focused on the wrong thing. They're focused on the money over here, right? Like they'll look over and say, whoever has the most money must be doing the best. But the reality of it is, if I own that corner right there, like my son did the other night, he owned that corner and I kept landing on him. His monopolies far trumped my monopolies on the board. It was kind of a funny little circumstance. And he finally kind of had his light bulb moment of kicking my rear end in Monopoly one night. And he's like, the 4 houses do equal a hotel, and I bankrupted Papa, and I thought that was pretty slick. But, that's what we're trying to do. We want the money to flow towards us instead of away from us. And most people, all you guys know this guy in this audience, most people are poor because they're taking their financial advice from salespeople instead of rich people. So here's the book we teach out of. This is the textbook version, Joey. We got the ultra thick college edition. I'm just kidding. It's really only 92 pages. But in there, he says, if some authoritative power distributed all the money in the world equally among all the people in the world, within 10 years' time, 97% of all the money would be under the control of 3% of the people. Well, those of us that have young kids know that we get asked this question all the time is why? And, I might be 43, but there's a little kid that resides in me too. And I'm always asking why. So the answer to that question is they understand how to get money to flow towards them instead of away from them. So we got to understand a couple principles before we can really move forward. And about money is it's the amount of interest. It's we got to focus on the volume, not the rate. All right. So it's the amount of interest paid in each payment over the lifetime of the loan that matters, not the rate. And if you have any, objections to that, just think about this. When you go to the doctor, it's not the rate or how fast they inject you that matters. It's the volume of medicine in the syringe. Not enough might not do anything, but too much might kill you. Now, principle 2 is lost opportunity cost. And this is the part that can really trip some people up because we think about cash being, such a powerful thing. Like Dave Ramsey's taught us, hey, you got to pay cash, but there's a little issue with that. And that is you give up interest or investment returns you could have earned somewhere else, even if you pay cash. So I'm going to use a kind of almost an obnoxious example of this, but I'm going to double a penny every day for 31 days. And I know it's 100% compounding every day, but it's just to kind of prove a point. And this is actually from Darren Hardy's book, The Compound Effect. So if a penny's doubling every day, it's kind of boring after a week. Heck, it's fairly boring after 2 weeks. After 3 weeks, it's starting to get a little interesting. But on day 22, if I'm just going to use the round number, $21,000, if I go buy a car with that, well, I just interrupted my compounding. So that means I got to start over. Now, if I start over on day 30, by the time I get to day 31, I got $2.56. Now, I don't know about you guys, but $2.56 annoys me. All right. I'd really like that 21,000 number better. So what's it look like if I don't interrupt my compounding? So when I get to day 31, I've got $10.7 million. So that's really the power of paying cash. Like when we're interrupting that compounding, it's such a negative drag on us. So how can I overcome that? So let's just kind of drive this home a little bit more. Hey, and guys, hey, Rob, if you've got questions or anybody's got questions as I'm going, this isn't necessarily meant for me to just talk. So feel free to stop me.
I asked a ton of questions when I sat through this the first time. But I'm monitoring the group chat, so I'll interrupt you if I see any really awesome questions. Brian Hermele said he read this in the thousands. So Brian's a real smart guy too. So let's listen up.
Okay, cool. All right. So there's really 3 types of people. We have the debtor, the saver, and the wealth creator. And I'm just going to kind of use this visual to kind of drive this home a little bit. So let's just talk about, let's say we're buying a car. All right. We're all going to start on the $0 line. So we got people that are going to borrow. So they're going to borrow money, you go into debt, and by the time they pay off that car, what usually happens, Rob? You got.
Sorry, I
go get
myself. Once you pay the car's depreciating in value.
Yeah, and so what do they go do? They go buy another car, and they do this over their whole life. And by the end of their life, where are they at? They're on the $0 line. Kind of boring, right? Not very exciting.
No.
Now, what Dave told us to do is delay gratification, save up, and buy cars like this. But I will tell you, this coincides right to when I started learning about IBC, infinite banking, is I had paid $35,000 of cash for 2 cars, one for my wife and one for myself. And I remember, because I had done Financial Peace University probably about a decade ago, and I remember thinking my entrepreneurial senses were screaming at me, saying, hey, that $35,000, you never get to earn money with those dollars ever again. And you bought, not only did you interrupt your compounding, but you bought a depreciating asset with it, like you said, Rob. So what happens is after 4 years, I buy this car and I'm back to thinking zero again. And that sinking feeling, I just remember I should have been excited about it and I really wasn't. So what happens? We do this our entire life. And guess what? We're back to stinking zero. All right. So, but what's that wealth creator look like? Well, that wealth creator, they save money, they use other people's money. We collateralize the purchases. Look, I got to make purchases. We're going to spend money. You're going to spend money to the day you die. And, you know, Nelson talked about in his book, he said, listen, your need for finance far outweighs your need for death benefit. We think about money and our need for finance every day. So just think about this. You do finance everything you buy. You're either giving interest to other people or you're giving up the ability to earn interest when you pay cash. So when I say that we finance everything you buy, there's no in between. So we are thinking of our need for finance every day. But then we're going to negotiate, we're going to borrow from a lender at negotiated rates. I don't have to go and haggle with the bank and shop around with the banks. When I control the banking function through my system, it's already done for me. So Albert Einstein said something, I just love this quote. He says, we can't solve problems by using the same kind of thinking we used when we created them. And IBC, the infinite banking concept, is about how to create your own banking system so that you profit from the banking instead of someone else. So here's the thing, we got to understand, how do banks make money? So really, it's very simple. We got a depositor who goes down to the bank. Now, Rob, do you remember this? When you deposit money in the bank, is that deposit an asset or a liability to the bank?
It's an asset.
So that's the normal brain talking to you. That's the consumer mindset.
Good questions.
So remember, it's a liability to the bank, but the bank has to do something to turn that into an asset, and that's the loan. They have to lend it out to a borrower. So if we were going to evaluate a bank, we're going to evaluate the loan portfolio. And I'm driving this home because if we're going to be our own banker, we got to understand both sides of this. Okay. So right here is really like the normal. Okay. The borrower is going to pay back the bank a little bit of scratch, and then the bank is going to pay us even less back. We see this all the time. This happens right before us. Any argument with that?
Nope.
But here's the thing. Let's put some numbers into play with this. So we go down to the bank and we deposit $10,000, just using a round number. All right. So the bank turns around and they're going to pay us 0.2%, and that's pretty generous. We're seeing unprecedented times right now where we've even flirted with some negative interest rate here. But for now, I'm going to be very kind and use 0.2%. So they're going to pay us $20. Now the bank turns around and they sell it for an average of 5.2%. You look at your Home Depot card or your Bed Bath & Beyond card that I know Luke uses all the time, and it might get 28% on that thing. So the bank turns around, they collect $520 on that. Now, Rob, do you remember how much better did the bank do than you did on that?
$500 relative to the $20 the consumer got.
Yeah, so that's the consumer mindset. But the business owner mindset, because remember, we're going to own a bank. A bank is the most important business in the world. The bank did, 20 goes into 520, 26 times. The bank made 2,600% more than you. Now here's the booger of it all. They did it with your money. Now the real sadistic part of it is that the bank can charge you to borrow your money, because there's really only one pool of money in the world. All right, so look, the common flaw with infinite banking is to make this more complicated than it is. But I want to drive home this visual. There are only 3 players in this play. There's the depositor, the owner, and the borrower. Right now, almost everyone sitting here is the depositor and the borrower, but the owner is the guy that made all the money. And infinite banking is just about putting a wall around all of that so that you can't lose money. Now, those numbers seem a little obnoxious, like 2,600%, but I just want you to know that was Bank of America's numbers from 2016. You think it's gotten worse? I don't think it's gotten worse. So, as Nelson says, if you know what's happening, you'll know what to do. And it's all about how you think. It's as simple as this. You write the checks to you instead of the bank. And the continued use of this system will create an ever-increasing pool of money for you, your family, and your businesses. And there's only one product in the world that will do what I'm telling you it needs to do. And it's a very specifically designed whole life insurance contract from a mutual insurance company. It's out of the reach of the government, creditors, and off the IRS's radar. So remember this, okay? This is what the insurance contract's going to allow us to do. And, you know, it's funny, you know, who knows about this? You know, the three guys on the left, they don't do it anymore for obvious reasons. And the two knuckleheads on the right, they do it. It doesn't matter what side of the aisle you're a fan of. But here's the thing. Plus, over half of Congress does this. And more importantly to me, every Fortune 500 company does this. They're buying the same types of life insurance contracts that I own, Joey owns, Luke owns, Jim Oliver owns. Okay, so we're just falling in line with the people that have the real wealth. And from a congressional perspective, I look at it, it's like, these are the guys writing the rules. So I feel like I'm in good company with that. Now, Walt Disney was actually started with a loan from his life insurance contract. Same with Pampered Chef. J.C. Penney's has been saved, you know, for now. Who knows how that's going to go. And then check out the cash values of life insurance that these banks own. Wells Fargo owns $21.3 billion in cash value in their life insurance contracts. You think they don't know something important? In fact, the government actually limits how much money they can put in their tier one assets right there. So it's pretty important. So infinite banking can work for anyone, all right? It doesn't matter how old you are, how young you are. The reality of it is you use a bank. Every one of us uses a bank for convenience at least. But here's the thing, we gotta think to do IBC. It's a participatory sport. So I've kind of thrown in some slides here. I want to show you guys just an example. You're going to start your own banking business. And I'm just going to use a $10,000 example. Okay. It's a small business. And in order to keep the doors open, you have to invest $10,000 a year. All right. So here's your business. You put in $10,000 into your banking business. And in that first year, you got $6,000. Okay. Now, if we were looking at any business, we call that an all right investment because there's going to be some, you know, we'll call it cash drag. Year two, when I put in 10,000, I get 8,000 to use. Now that's pretty good business. We're getting better. Our profit's getting better. In year three, I put in 10,000 and I get 10,000 to use. Year four, I put in 10 and I get 11,000 to use. And in year five, I put in 10 and let's say I get 13,000 to use. Now, I don't care what business this is. I don't care if it's a McDonald's, a trash compactor business. I'm interested in buying that business if that's the right side of the ledger, where the cash that I can take out is growing respective to the cash that I'm putting in. So let's just look at your IBC business, okay? And a little bit of an example of putting it into motion. Remember the participatory aspect of this and what Rob was saying about using the money. And when I say using the money, I kind of want you to think of it like this. You know, if air doesn't flow through your lungs, you die, okay? If water doesn't flow, it becomes stagnant and it's poisonous, all right? If money doesn't flow, it's dead, okay? Motion's a law of God. It has to happen. So it doesn't matter. Like if you're, you know, Kiyosaki, I know a lot of you are fans of Kiyosaki. When he's talking about savers or losers, that's what he's talking about. So let's look at year one. I put in 10,000. I've got 6,000 to use. Well, remember, if you own the bank, you got to put that in motion because the loan is the asset. So let's just say that I got a car loan over here. $6,000 car loan, and I'm paying $500 a month. So I take that $6,000 and I wipe out that loan, and instead of that $500 going to somebody else, I'm going to redirect it back to myself. Okay. So I got the $6,000 back after a year. Year 2, I put in 10,000. Remember, I get 8, plus I get the 6 from the year before. So I have $14,000 to go take down, eliminate a debt, handle an emergency, or take down an opportunity, because we're all opportunists when it comes to real estate. So you've got an inventory loan, let's call it that. So I got a $14,000 inventory loan that I'm paying $1,000 a month on. So I wipe out that loan, and instead of that $1,000 going to someone else every month, I redirect it back to myself. So after a year, I've recaptured 12,000 of those dollars. Year 3, I put in 10. I got 10 to use. This is just like my checking account now. So I've got the 12 from the year before. So I've got $22,000. Now I got a tax bill. Now, is there anybody on here that's not paying taxes? I highly doubt that. So everybody's got a tax bill. So we got a $22,000 tax bill that we're going to pay $2,000 a month on. Eliminate that, and I redirect the $2,000 a month back to myself. So I got $24,000. Year 4, I put in 10. Remember, I get 11. So my dollars are leveraging right there. Plus I get the 24 from before. So I get $35,000 to go attack opportunity with. So let's review the numbers. Month 1 through 37, I've put in $40,000. I've paid off $42,000 worth of debt, but I have $35,000 of cash value in there. So we're going to talk about this a little bit later, but it's the importance of this being an and asset, that money being in the policy and being able to use it is what is most important about this, and what separates it from anything else that you're using right now. So let me use this visual right here. So we have income, it comes into our policy, and it goes out for our lifestyle, major purchases, taxes, and savings and investments. I'm either going to pay cash or pay interest. I could have lost earnings with that. But what I'm going to do here is I'm going to redirect that back to myself. Remember, we talked about instead of that going out, it's going to come back towards us. But here's the thing, with my savings and investment, what am I going to do? We all love cash flow assets. So I'm going to go buy a cash flow asset. I'm going to buy another cash flow asset. And that money flows, instead of flowing away, that money keeps flowing towards us. So remember that circle I put around the depositor, the owner, and the borrower? Remember, it's just the flow of money. It's just the simplicity of that. So at first, when I put in $1, I might get a little bit, less than $1, okay? But as I go, remember, when I put in $1 or 10,000, I got 11,000. Well, the cash value is growing inside, uninterrupted. So I put in $1, now I may get $2. And remember that blue line, it keeps getting more and more efficient. So at some point, when I put in $1, I'm going to get $3 to use. It's killing my checking account. Then I get $4.
Interject real quick?
Pardon me?
Can I interject real quick?
Please.
So guys, think about all the deals that on paper that you look at, like, man, this would be a great deal if I didn't have a loan on it. If I bought this cash, it would cash flow and be awesome. Like, it makes every deal, if you're the bank, every deal is a cash deal, essentially, and you're paying yourself on the interest. I mean, Luke, is this one of the main draws?
You can also use your cash value as a 20% down payment to take down a larger property as well, which is one of the draws. I'm hoping that maybe one day I might be taking down some larger properties. And my question is, where are you going to get that money? Well, you're going to have to build it up somewhere. I'll have equity in properties, of course, but it'd be nice to have that in an account, ready to go that you can use. If you're going to burst something, say a larger property, and maybe it's hundreds of thousands of dollars, bringing 20% to buy it, fix it up, and then eventually maybe you could refinance it. You can get that money back that way too. So there's a lot of different angles you can play with it. But as far as I'm concerned, I think for people that are going to use this money to help grow a business and for business use, I know Nick said before, and you got to talk to your accountant, but that interest that you pay on those loans, I believe, is tax deductible. Or is that right, Nick?
Yeah, I mean, my CPA agrees. I'm sure Joey's does too, and I know Jim Oliver's does as well. Is that the insurance company is just another financial institution. So we're going to be wind up borrowing their money, and I've got an illustration to show that here. But when I use their money, while my money grows uninterrupted, of course there's an expense there. So I still have a deduction with that. But the most important piece of that is that I never interrupted my compounding.
Right. Right.
So as I think about this, okay, if you could write a check today, okay, and for $1, and you were going to get $4 back, how big of a check would you write? So I want all. That's right. I want all of my income to do that. If I made $1 million this year, I want all of my money to flow through my insurance contract. I don't want to think of this as a little side investment as my policy. I'm trying to leverage all of my dollars, because here's the thing: you might beat me the first year or two with your checking account compared to what I'll do in the policy with a little bit of cash drag. But once we get past a couple of years, I'm going to blow right past you, and you're never going to catch me. 10, 20 years from now, when I'm putting in $1 and I'm getting $2 or $3 to use to go take down more deals and build my wealth, whether I'm buying businesses, I'm buying real estate, it doesn't matter what it is, or, who knows, maybe it's my kids' educations, it's vacation homes for us, it's whatever we want. I get to do whatever I want with this. That's the great thing. There's so little rules on this. If there's almost no rules on it.
There's no yearly limit, right? Correct, on how much you can put in.
No, there's no yearly limit. I can live off the cash flow from it. I don't have to put the proceeds from the assets that I'm using this with back, into a particular vehicle. I get to do whatever I want. So I'm gonna show this a little bit better here. So the key is, I'm gonna use this visual. We got the policy. It's growing. It's tax-free buildup. Okay. The money's going in post-tax. So I get tax-free buildup to the day I die. I get death protection, illness protection. There's a tax benefit. There's a reason why all these wealthy people put their money in dividend paying whole life. Okay. So now I have this bank of convenience, so like I bank at Republic. And so that's my bank of convenience here in town. I've partnered with this insurance company. And when I want a loan, now everyone here knows that if you go try to take a loan at the bank, or you go to, a hard money lender, you gotta apply, you gotta fill out all the paperwork, you gotta beg, borrow, and steal almost, right? You gotta tell them when you're gonna pay them back. Do you have a good FICO score? What's your job? All of that. Here, I don't do any of that. If I want a loan from my insurance contract, I just tell them I want a loan. And if I wanted to, I could pay them $20 and they'll wire it to me the next day, or in a week, 10 days or so, I'll have the money in my checking account, no questions asked. But here's the thing: it's an interest-only unstructured loan. I get to decide all the terms of when I pay it back. It's vital, because if I go and I'm trying to buy a flip home and I might have, project a 6 or 9 month hold, well, I don't want to be tied down to having to pay that back in 3 months. Or what if I wind up holding it for 2 years? Well, I don't want that burden of saying, hey, I got to convert this from a hard money lender to a traditional note or whatnot. This is all pre-negotiated. I'm paying a few percent interest, and I get to decide when I pay it back. But all the insurance company is going to do is place a lien on my cash value. I'm using other people's money. I mean, Kiyosaki just belabors that point of OPM, use other people's money. I'm going to use the insurance company's money, and I'm going to go put that to work. So I go take down this asset, this real estate asset, and it spits off cash, okay, because I did my due diligence properly. I got cash flow coming back to me. Now, if I decide to pay the loan back with that cash, every dollar that I pay back, the insurance company releases part of that lien. all right, until I pay it all back, in which case they'll release all the lien. All right, but remember, my money never left. So I keep doing this. Then I come along a business opportunity. Guys, I know we're on a real estate thing here, but I've got a good sense, I think like we all do, that there's gonna be a lot of businesses for sale here too, coming up. So maybe there's a business that you're interested in and you have an opportunity for that. So I could take a loan from my insurance contract. I buy this business, it spits off revenue to me. I flew it back through my bank of convenience, back through the insurance contract. And look, my money is continuing to grow. That policy could be full because maybe my first policy, that first branch of my bank, could only hold $100,000 a year. But I need another one. I didn't make my bank big enough. I don't know about you guys, but I've never been able to go to Republic and make a deposit so big that they said, hey, I can't take that. So we want to make our banking system as big as we can to hold all of our income. And it takes time. It's a process, and that's what we help coach people through. But look, I can just keep doing this over and over again. Maybe it's a market account. You know, we got clients right now that are like, hey, I think if the Dow goes to 13,000 or 10,000, I'm going all in. I know we just had a client took a policy loan to go put money in Wall Street right now. We don't make that investment advice. I'm not going to tell you what piece of real estate to buy, but we'll help you evaluate deals so that you can come through a clear understanding. So, hey, Jim, are you there?
Yeah, I'm on.
Is Oliver on there?
Yes, I'm on.
Oh, you okay? Cool.
I was if anybody's ever seen me type, including Nick, then I was trying to type some responses, but anybody that read any of my responses in the chat knows that I can't type. And because I can't type, I don't spell very well while I'm typing. So,
hey, everybody out there, Jim Oliver is a friend of Joey and mine, and Jim and I have been working close together for 5 or 6 years. And the one thing Jim helped me understand is that I needed to put more money into my policies than what I was putting in. But to understand how impactful this is for the real estate investor. Jim and I have a podcast called Breakaway Wealth where we talk about these types of things all the time and have some video resources out there on YouTube and whatnot. But Jim is the one that really helped my light bulb go off about using these policies to take down real estate deals. And he's put together these slides here. So I'm gonna let him do these couple slides because he does them the best of anyone that I know. So go ahead, Jim.
okay, so this is a very over simplistic example, and the reason that it's overly simplistic is because we want it to be easy to understand. So just know that we know there are other details in there. I'm not even going to go into the monthly expenses and all of that or the depreciation because we already know that those are going to be a different that they're going to be, the expenses are going to be the same regardless of how you buy the property. But this first example is I'm going to go buy a $200,000 property, and you can see, Nick, can you draw on there or not?
It's not letting me very well.
Okay, all right, no problem. So it's the top left where it's under property information. It says $200,000 property value, price of the property $200,000, $5,000 closing costs, total purchase $205,000, right? So let's say that this is a really good piece of property, and I'm going to get a gross income of $2,500 on this property. By the way, if you have this property out there, let me know. And we're going to analyze that for 10 years, 120 months up there on the far top right, and we're going to say that it's going to appreciate at 3%, just something, right? So we put a $205,000 in. Our net monthly income after expenses, because we don't have any expenses in there, is $2,500. And our net monthly cash flow is $2,500, and we cash out at a little under $270,000 in 10 years. And our rate of return is 16.12%. Okay. Now, this is, like Luke said earlier, this isn't how most people buy real estate. What most people do is they put a mortgage on part of it. And let's just say that we could get 80% loan to value, and we're going to take out a $160,000 mortgage. Okay. And our payment is, and by the way, this is going to be a commercial loan, 20 years, 5%. And our payment is $1,056 per month. Okay. So all of that goes into our expenses up there for the mortgage payment. And we still look at the 10 years. We're still analyzing it 10 years, 3%. All of that is the same, but our net monthly income after expenses goes down. We have our interest payment in there. And then our net monthly cash flow is $1,444, right? Now we still have a balance after 10 years on our mortgage. So, we show that as almost 100 grand. So our cash out is 170 instead of the 269 or almost 270. But look what happened to our rate of return. This is why people buy real estate this way. Our ROR went up to almost 42%. Okay, so like Luke said again earlier, if we're doing infinite banking, then that $45,000 down that we need, right? Then we would use that from the insurance company. We'd use their money. So if you look at that second mortgage information now, by the way, the insurance company, as Nick said, gives you an interest-only loan. But Nelson always said you want to be an honest banker. So if the bank was going to charge you 5% and they were going to put it on a 20-year AM, then that's how you should pay back yourself. Okay, at least that, and maybe more. But so we're going to take a $40,000 loan to go with our $160,000 first mortgage. Okay, now remember, our money isn't going anywhere. It stays inside that insurance contract, growing every single day, even for the last 3 weeks. Okay, growing consistently. And we're gonna do the 20-year 5%, and our payment is $254. Now our monthly expense goes to $1,320, and our net monthly cash flow goes to $1,180. Everything else is the same. 10 years, 3% appreciation. Our balance on our loan is higher, right? It's $124,000 after 10 years. Our cash out is then $145. But look what happened to our rate of return. Our rate of return went to over 370% because we're leveraging more, right? We're using somebody else's money. Now, by the way, you've probably already figured out that we could have borrowed the closing costs too. And if we borrowed the closing costs and we didn't come up with anything out of pocket, and we still had this cash flow and this net cash out of $145,000, what's our ROR? Infinite.
Luke?
Yeah,
Infinite.
go ahead, Luke. Yeah.
It's like a burr, but it's on the front end.
That's right. That's right. So, those are, I mean, that's the essence of infinite banking when you go out and you buy businesses or real estate or, whatever real estate means to you, right? Could be a lot of different things. Does that help?
Yeah.
Any questions with that, Rob or Luke or Joey or Nick?
Joey and you guys are doing a great job answering questions in the group chat. Keep up the good work.
Yeah, trying to help answer some of those as you guys are talking. I think here's the really bottom line about what Nick and Jim are really sharing with you guys today is your money has to reside somewhere as you're doing deals, as you're waiting in the wings for the deals to hit, to come into your lap. I mean, we're having conversations with investor clients of ours right now that are like, man, they're sitting at the Christmas tree waiting on Christmas Day. Okay. They're just like, man, they're so excited right now because I mean, even yesterday I saw an email from Zillow about a builder locally that just slashed prices by 50 grand on some of their $600,000, $700,000 houses. And I thought, here it comes. This is just the tipping point where we're going to start seeing those direct mailers that you guys are sending. Your response rate just went up, by the way. Not because you just wrote it any better, but because their situation has changed overnight. And this system is just a replacement of your savings account. I've never heard somebody that came into my office and said, man, I'm just really a super fan of my savings account. Like you cannot improve my savings account. It's the best thing ever. No, if somebody's sitting on $100,000 in their savings account, they're actually kind of pissed off about it. They're kind of like, man, this is a waste. Why do I have this money sitting in my savings account? And the reason is because they know that it's only doing two things. It's only in a safe place that won't go down in value. At least what we think right now, right? I mean, who knows? We can get on a whole nother topic, but as of right now, your saving account needs to be enhanced. And that's all that infinite banking does, is it puts you in position to take advantage of greater return, tax-free increase, creditor protection, by the way, something that I'm sure Nick's would talk to you about, and this uninterrupted compounding. The most powerful thing that you need is, as you're doing deals, as you're going to be just mopping up over the next 3 or 4 years, you need your cash to continue to grow, because you can't ever get this time back, but you're going to be so actively buying deals and taking advantage of this, your cash should be growing too. And that's all that he's talking about. There's a ton of stuff he shared with you that is super valuable, but if you don't get that, then you miss the whole thing. So hopefully that's valuable.
Okay, so you're going to be able to buy right now. I mean, the market, some things are going to go down in price quite a bit. I mean, you guys are using, like, you're writing a check, right? Your account. So you could literally pull money and buy the next day.
Yeah, absolutely. And just like anybody else, once you start working with a bank, I mean, if I could call I actually own part of a bank in South Dakota. Hey, I want 80% loan to value, and I can go back. I mean, I can close on something ASAP. It's kind of funny, Luke. You remember that big white house by the beach I sent you?
Yeah. That's cool one.
Yeah. So the guy calls me, or he texts me 2 days ago. He says, "Still in the market?" I said, "Yep, still at 75% of ask," and I haven't heard back. But but man, I'm excited. The rebound from this thing is going to be, there's going to be prosperity in this country for people that take advantage of it. And one of the things about being your own banker is it allows you to be in control. That there's two words at the top of there: use and control of other people's money. Well, that's how the bank makes money. And here's the cool thing, just like Nick was saying and Joey's saying, is we get both sides of this ledger. A lot of the questions are asking about, different types of policies and everything else. And it's really, the design of the policy is really important. The company is important. That needs to be a mutual insurance company that supports this. And one of Joey's answers was Northwestern Mutual. They don't support this. They don't train their agents how to do this or why they would do this. In fact, if you take a loan from a Northwestern Mutual policy, your agent actually gets a reduction in their service fee. So they don't like that. You got to find an insurance company that will allow the right kind of design and supports it, has good interest rates. But what you really need is somebody to show you how to do this that has done it. You want to know how to buy a business? We've done it. You want to know how to buy real estate? We've all done it. You want to know how to buy anything with this? Set up a leasing company for equipment if you own a business or anything else. But the cool thing is that you get both sides of this ledger. There's no other asset in the world that you can do with that. If you find one and you don't tell us, we will hunt you down. Okay, because this is the coolest thing. I've used this for a long time, and it's increased my wealth dramatically. And it's one of the reasons we share it, is it's just to help you take advantage of it too.
Hey Jim, the way that this is on my iPad, it's not letting me draw on it worth a darn. So if you want to draw something out there,
I might be able to do it on the PDF annotator, but I don't know if it's not letting me share. I don't think. Is it? No.
Yeah, okay. It should let you.
You were viewing Nick's screen.
I'll unpin my video.
You cannot start. Okay. Now I can. No.
See if you can share.
It says you cannot start screen share while the other participant is sharing.
All right. How about this? I'll stop sharing. There we go.
All right, here we go. Now it's going to let me. So the cool thing is you have all this. This is the ledger here, right? You have the policy over here, and then you have your behavior over here. Now, a lot of times what I get is, well, I don't know what I would do. You know, I don't know what I would do with the money. The cool thing about this group is you guys are in real estate. That's what you know, right? That's what you're learning how to do. So we've already got this side of the ledger down. Now we just got to build this big money pool because we want as much money in here as possible so that we can go put it in motion. And then as these real estate assets cash flow, we're going to flow the cash back into the policy, which is going to reduce the lien, increase the cash value. We're going to add more policies and more policies and more policies because we want as much money in a tax shelter as we can get so that we're not vulnerable in the future. But think about this. You're going to have all these different real estate assets over here. Here, you're going to be able to get the money out 0% tax. And here, you're going to have tax-favored assets, not instruments like the rest of the herd out there buying mutual funds and things like that. You're going to have assets, right? And again, you get both. Now, that's what's really amazing is this cash flow. You know, we're not talking about how to build a retirement plan. We're talking about how to build a cash flow system that will provide you with as much money as you would need for your ideal standard of living in excess of that, and somebody else is paying for it. Now, to me, that's pretty cool.
Yeah, we talk about all the time with our audiences that we're trying to help people build their passive income to meet or exceed their ideal standard of living, like in a big way. Because if you can choose to not answer the phone or choose to not go to your 8-to-5 job, well, that changes everything. Money buys choices and choices buys freedom. So as we acquire these cash flow assets, you know, we want to be able to control all that cash flow. If we want to use the proceeds from a deal to go on our dream vacation, take our family on that, then we want to be able to do that. We want to take those proceeds and go buy more real estate. We want to be able to do that. So anyway, it's just about having the freedom and control, and the banks, they have all the control. And so if we can take back control in an uncommon way, I mean, we're seeing right now, you know, I put it on Twitter yesterday. It's like, if you give a man a gun, he'll rob a bank. If you give a man a bank, he'll rob a nation, you know. And that's what's happening right now is we're seeing, you know, this $2 trillion we just printed, that's not for free. So, you know, anybody that thinks our taxes are going down in the future, I think we need to go have a cup of coffee and really lay that out. Or I would encourage you to watch, there's a great documentary called The Power of Zero. And it really lays out, I mean, shoot, imagine when McKnight does the updated version of The Power of Zero here in 6 to 12 months, right, Jim?
Absolutely.
I mean, you know, getting David Walker on there, the former comptroller from the United States, you know, he's encouraging people. You got a guy like that who sat as the United States comptroller, which is basically the CPA of the United States. He's like, you know, who's going to shine coming out of this are the mutual insurance companies, because they're in an uncommon position. They're just steady. You know, it's a safe place to put our money. As Joey said, our money's going to reside somewhere. Everyone, you know, if you're not doing this already, you're letting somebody else be the banker in your life. And guess what? As Luke discovered the other day, you can't always go get your money out of the bank. So, yeah. I mean, I know we've all been there. It's aggravating, you know, so we just want to have control. That's it.
Well, and let me just throw this in there. Like, you guys, if you're on this call and you're involved with the Real Estate Investing Association there, the group there, you already have a path that you're going down for financial freedom, right? You're already on. You already, first of all, hats off to you that you're not bought into just this retirement game that we're being taught. You're building cash flow assets. Maybe it's through wholesale, maybe it's through fix and flips that then you buy into long-term rentals, or whatever it may be, lease options. But whatever your strategy is, that's your long-term financial freedom path. All that infinite banking is going to do is it's going to enhance all the things that you're doing tenfold. It's going to give you all the same things that you're wanting on the other end, but you're now going to get the cash, as Jim was just mentioning. You're getting both. Why not? I mean, I don't know anybody that says, yeah, you know what, hold back all the interest that I could have been earning this entire time. I don't really want that. No, because that could equal a much faster way. We talk about on our show, take control of your finances, pick your path, and get there faster. Well, how do you get there faster? If interest is behind you, or as the name of Nick and Jim's company is, CreateTailwind, right? Get the tailwind of interest to enhance what you're already doing. And infinite banking is the tool that does that. If it was something else, guys, I promise you, Jim and Nick and I would rather not talk about life insurance. It's just not that popular, to be honest with you. Like, people hate it because of guys like Dave Ramsey. But if it was something else, if I said, hey, man, there's this new savings account that Ally Bank just came out with, and you know what? It grows tax-free. It grows at like 3 to 5%. You can borrow against it at 5% simple interest only, with no restructured repayments. And it also has a death benefit, and it's not subject to creditors. You'd have people literally out the door signed up for it because it was a banking savings account. All we're doing is changing the name. It's always been there. We're just literally calling it, I mean, it's just life insurance. So anyways, hope that helps.
Oh, yeah.
Yeah, I mean,
I think that go ahead.
I was just gonna say, I mean, I've been looking into this for a while, and I'm not gonna say I'm not gonna sit here and say that I understand everything perfectly, because I definitely don't. But it makes enough sense to me to feel like I want to try it out and see, you know, where I can go with it. I think there's a lot of people that I've talked to about it in the local community, and it sounds like most people just think it's a total scam. And I hear you. But I don't know that I don't necessarily agree with that. I think there could be ways to use this to benefit. And I know there's other things that are maybe similar that you could use also. But I don't know. We'll see. We'll see. I'll let you know what I learn about it as I go through.
We'll bring it back with Luke in like a year from now and see how
Yeah.
it's
So, but I mean, the whole idea of recapturing the banking function in your life is kind of what draws me to it, and being able to use your dollars essentially twice. You're saving them and you're borrowing against them. And I don't know, there's a lot of things that I like about the idea about it. So we'll see. I don't know.
And everybody just loves Luke to death and respects the hell out of him. So I think that's what piqued people's interest on being on the call. Now, guys, this material, it's awesome and badass, but it's kind of dry. If you're just kind of hitting it in the middle, you're like, what the hell is this? Like, there's a guy named Bobby that just got in here. He's like, what? But the fact that we've had over 50 people stay on this call, I mean, shows that there's a lot of interest in it. It's just, you get on Reddit or you get on whatever, and if you're not going to utilize the policy correct, like term insurance and whatever, is probably a better buy. But if you're going to use it correctly, I mean, it just seems like a real asset.
Yeah, most people are not going to be willing to get out of the convenient lie line. Honestly, there's two movies playing. You got the convenient lie line and you got the inconvenient truth. And the reality of it is, most people aren't doing this because they're going to stay in the herd. And that'll make some people uncomfortable, but that's the reality of it is, you know, most of you guys that are real estate investors, you're already breaking away from the herd. You don't want to just chug along in your 8 to 5 job and just work for the man. You're trying to figure out how to take back control. Well, guess what? Unless you're your own banker, you're not really taking back all the control that you could. But again, it takes some courage and some conviction and some coaching to break away from the herd. You know, that's why we call our podcast Breakaway Wealth. You know, it's the strategies of the rebellious and the unconventional. But
we call this see you at noon because we meet at noon.
Yeah.
Yeah.
And
No,
can
it's
you give a practical example of what you just did in Tennessee on that complex you just purchased? How you used the policy, how it worked?
yeah. We got a podcast episode coming out, I think in 3 weeks about the deal, and we recorded a YouTube that we'll put up concurrently with it, just because there's a lot of numbers involved in it. But Jim and I and another one of our guys in our firm who he's a 23-year-old wholesaler that was about a year ago discovered Infinite Bank.
Uh-oh.
Uh-oh.
We lost you, Nick.
All right.
Come back, Nick. Come back.
Nick.
Yeah, he just is frozen.
Yeah.
I can tell you about that deal. So he was talking about a guy who's running our Knoxville, Tennessee office. He brought us this deal, and like Nick said, he's a 23-year-old guy. I almost said kid, but he's a 23. I'm 54. I can call him a kid. He found out about infinite banking. He went to the NNI. They referred him to us, and we've been mentoring him. And he's a great young guy. So he found this deal, the seller finance deal. It's 13 properties, and the owner, they were going through a divorce, the owners, and the husband was willing to finance a big chunk of it, obviously about half, right? His portion at 0% interest for 18.75 years. And the reason 18.75 years is he wanted a certain dollar amount per month, is in his head what he wanted. And so we were able to sell a couple of the properties to make up a big chunk of the wife's side of the equation. And then we used our insurance contracts. We all went in on this deal, a third. And we all borrowed from our life insurance policies for the down payment. So now we've already made some money, by the way, but I won't get into those details. But we don't have any money in the deal other than the interest that we have to pay the insurance company until we pay off that loan, right? And so that it really allows you to get deals out there at just a much higher rate, and not feel like I don't have to decide, am I going to have this money or am I going to have this property? I get both.
Yeah. Yeah. And that's what I like about it, Jim. I like that piece of it. You get to earn your interest and you get to borrow from it at the same time and use that to buy stuff. Because when I'm thinking about buying, say I want to go out in 20 years and I want to buy $1 million apartment complex or $2 million apartment complex, I'm going to have 20% down payment. Now I can go and I can syndicate that if I wanted to go that route and use other people's money that way. But wouldn't it be a lot more profitable for me if I had that money somewhere that I could pull from and that I could put down as my, $200,000 down payment or whatever. And then, it's possible to figure out how to flip that property or increase rents, increase the value, something like that. And maybe go pay back that policy at some point and then go do it again. And the entire time that $200,000 is going to earn interest in the life insurance account while I've already used it to buy a property.
Luke, what happens if you die?
Then
well, you get the death benefit, but that's not really like, as far as what I understand, Jim, you correct me if I'm wrong, that's not really the benefit. That's not the biggest benefit here with using this policy. The death benefit, yes, that's something to consider. But it's you're minimizing with these policies. I believe you're minimizing the death benefit and maximizing the cash value increase so that you can use the money now, because who cares about what you do with the money when you die? If you want to pass it down to your family, that's great. But the best thing to me is being able to maximize the amount of money that you can use now and in your life to invest and do whatever the heck you want to do with it. Whatever makes you the most money, whatever you choose. Am I right about that?
Yeah, absolutely. You're spot on, Luke. But if you die, your family gets a big tax-free death benefit.
Yeah.
So I always try to tell my wife, try to look sad at the funeral, will you please? I don't want her to be yelling bingo at my funeral or anything. So, but by the way, if you to talk about how this really works a little bit, or you want to, I think one of our best podcasts was when I interviewed Luke about how he got into real estate. I'm sure you guys have probably all heard that story, and we just talked about infinite banking, I think a little bit, Luke, on how you kind of saw how you were going to use your plan.
Yeah. Yeah.
And somebody asked about the book. And if you want to go to CreateTailwind.com and register and put your information in there as a gift to the people on this group. I haven't, before I make this offer, I haven't seen how many people are on here, but we'll give you as a gift from us to you. We'll give you the book, Becoming Your Own Banker.
Yeah, hey, sorry guys, my computer, great timing right in the middle of me talking. But I've already gotten a couple emails from some people saying, hey, I want the book. So keep that going. And I'm here in Louisville too. So once the goofiness is over, we can meet in person too if anybody wants to.
I don't know. I don't want to hijack your presentation because I don't know what you're going to get to next. But why don't you explain what a MEC is and how this is so powerful they created a rule to keep you from being able to get too far ahead with it?
Yeah, Jim, you want to draw out the efficiency?
Sure, yeah. So this is just kind of a simplistic way to look at it. But, when you look at a life insurance contract, there's a minimum amount you can pay. And let's say it was, we'll just say some death benefit. Okay, let's say it's $500K. There's a minimum amount that you can pay, and there's a maximum amount you can pay. Now, who sets the minimum? The insurance company, right? They decide the minimum amount that you pay. You can they do this actuarially. There's the actuaries are the engineers for the insurance companies. They're going to make sure nothing fails, right? And so when you pay the minimum, that's called term insurance. And there's only one benefit in term insurance. You have to die to get anything out of it, right? The way you win with term insurance is you write the check for the premium, you go outside, you get hit by a truck. And then that's how you win. But by the way, when you buy insurance, when you buy term insurance, are you betting with the insurance company or against them? Against them. That's right. Because you think you might die. They don't think you're going to. And so let's say you're 35 years old, Nate, and you buy a 30-year term policy. Okay. Your chances of dying before 65 is less than 1%. Now, what are your chances of dying after 65?
100%.
100%, right? They don't want you after that. Right? They're not going to say, hey, we're going to give you the same rate. We'll just keep this going the way it's going. No, you're done. Okay, so now the maximum amount that you can put into this $500,000 policy. By the way, this is not how we design insurance contracts. We design them for the banking and the capitalization that you want to put in your own bank. And we make this the minimum that we can make it. But there's a maximum that you could pay for this policy, and that's set by the government. Now, the government did this by passing two laws, TEFRA and DEFRA, back in 1986 and 1988. Now, the fact that the government would limit how much money you could put in an insurance contract has to tell you that it's good from what standpoint? Well, it's good to save on taxes because they don't want you to put too much money in there, or they don't get to collect taxes. And the other thing is that if you put too much money in these insurance contracts, then you wouldn't put money where they want you to put it, which is where? Qualified plans, 401ks, those kinds of things. Now, why do they want you to put money there? So they can tax it later, right? I think of you guys that are in your 30s, right? I mean, Luke, you're going to put money in something for 20, 30, 40 years and not touch it. And if you did have an opportunity, you had to pay a penalty and whatever the current tax is. That doesn't make any sense. And by the way, if you don't need it at 70 and a half, you have to start taking it, whether you want to or not. Okay, so the government sets this. Now, what happens if you go past this line, this maximum line? The policy becomes a modified endowment contract, or a MEC. And what it means is it acts like a qualified plan with all the taxes, penalties, rules, all of that. That means the government's in control. The qualified plan defers the taxes, yes, but also the tax calculation. Are taxes going up or going down? Hopefully everybody said up, right? Okay, the other thing is that they say you're getting this great tax break on the front, but that's like saying, hey, I don't want to pay tax on the seed, but I'll pay it on the harvest. That doesn't make any sense. If you ask any farmer, he'd say, I'll pay the tax on the seed. Let me keep the harvest. That's what the insurance contract does. Okay, so makes sense. Okay, so
what'd you say, Rob?
Like a self-directed IRA, you're paying what you put in initially, and not on the harvest, if you will.
On a Roth.
Self-directed.
Yeah, self-directed. Yes. Yeah, I'm sorry, I didn't hear what you said. Yes. Okay, so let's go back to this efficiency spectrum. Okay, so let's say that this is the efficiency spectrum for cash value in life insurance. Okay, on this side you have the most efficient, and on this side you have the least efficient. Now the most efficient would be I put in $1, I have $1. Because if I put in $1 and I have $1, what's my cost?
Zero.
Okay, so this is a one pay policy. So, by the way, over here I put in $1. I have $0. No matter, even if I put in $1 million, I have $0 of value that I can use. Okay. Now the government said, again, that's not life insurance. You don't get all the tax benefit that a life insurance contract gets. They established that MEC line. It's right, it's somewhere in here on this line of efficiency. And just to let you know, like variable life insurance, universal life insurance, index universal life insurance, and whole life insurance are somewhere in the middle. Okay. This isn't available anymore because of this MEC. But what is available is a paid-up additions rider. So you can combine this with a whole life policy, and you can get that efficiency right next to that line without crossing it, right next to that line by combining these two things. Now, we typically don't like to combine a term rider to try to move that line because you can MEC the policy. You have to keep the term rider on there a lot longer than people on the internet show you, because the way that it works is you have to keep it on there 7 years after your last PUA payment. And they only show that they're keeping it on there sometimes 10 years. Okay. So we can't cross this line, but we can get it really close. And by the way, one of the questions earlier was, why haven't I heard of this? Or what are some objections? And a lot of people say, well, why haven't I heard about this before? Well, your insurance agent really isn't going to tell you about paid up additions riders, because if I put in $1 and I can take out $1 and my cost is $0, how much do you think they pay the insurance agent for that? Not much, right? But so the insurance agent wants you to do this, but we want to combine it to make it as efficient as possible. And to give you an idea, one of the companies that we were working with, all of these companies came out with new policies last year. But this company, you put in $1, you have, 60 cents or 62 cents the first year, right? The next year you put in $1 and you have $1, right? And it only gets better from there. Now, this is our only cash drag. This is our only investment to get our money in the tax shelter. And we're going to leverage and make that money back depending on your age and your underwriting class and everything else with a few or more years after the second or third, or it probably would be around the 6th or 7th year. Every dollar that we put in is available in the tax shelter. Now, we haven't even started infinite banking yet. That's just how we designed the insurance contract. So I'm sorry. That was a long answer to a short question, Nick. So I apologize.
That's all right. It's the total explanation. But here's the thing everyone needs to understand about that. About the MEC is you don't have to lose sleep over it. The insurance company takes care of it on their end. You're not going to accidentally MEC the payment. So just know that can get, every insurance company figures it differently. There's the general guidelines of it. So the number is going to be different, but it's clearly on the policy. And, we just try to keep it simple. So I just to try to bring it back is, listen, there's 3 players in this play. There's the depositor, the owner, and the borrower. we showed that the owner makes all the money. Okay. You can put money in the bank and as the borrower, go make money with it. Okay. While your money grows uninterrupted in the policy. All right. You can go use that to take down a business opportunity, a real estate opportunity. But, it's like, why would I want to go buy more? Let's say I had that $200,000. Let's go back to that. So I can buy that one piece of property and have that one piece of property appreciating for me. Okay. Or I could go take down, we'll say 5 properties, right? At 20% down with the $40,000. Now I have 5 properties. I have that economies of scale. I don't know, Luke, do you like economies of scale?
I like them yeah, they're great, but I have a lot of single family houses is the only thing.
Yeah, but you can look at that as the whole though. Like if you had 10 single family homes, if you lose one renter, you only lose 10% of your revenue, right?
Right.
But in that case, you'd have 10 properties appreciating, 10 properties cash flowing for you. So it's the power of being able to leverage that. Leverage is almost, if not more important than compounding. So, and especially, we just printed 10 trillion more. I mean, somebody's going to go make money with those dollars. They're going to hit our pockets if we go take action. And what I would say is, Nelson challenges us to think. And, I give everybody credit on here because you're all willing to think, because you don't come to real estate meetup groups at noon on a Friday if you're not willing to think. You don't go to meetings on Thursday nights if you're not willing to think. But there's going to be a lot of noise right now telling you to be scared and hunker down. And the reality of it is, what Chase Craddock and I were talking yesterday is, now's the time to shine. Now's the time to be ready for opportunity, to be ready to strike. It's not the time to be foolhardy, but I think that a lot of your competition is going to fall by the wayside right now. And you're going to have a lot of opportunity out there because you're willing to take action. And that's what I would focus on for you guys, is taking control fundamentally. We could do this conversation with each of you individually and answer your questions individually. It's everybody's situation is different and how they're trying to implement this in their life and the available cash that they have, or their business situation. But we got people that are looking at trying to figure out how to run millions of dollars of revenue through these things from day one. And that's what we're here to do, is to help craft that for you. Or if you've got just a couple $100 extra bucks a month right now as you're starting off trying to put it together, I mean, everybody's got to start somewhere.
Nick,
And
you run your car insurance, your electric, your water bill, all this stuff is going through your policy, correct?
Yeah, I'm to the point now where all of my income flows through my policies.
It's awesome.
Jim, I think you're the same way. That's it. I mean, I wanted to get there because I showed, listen, when I put in $1, and I'm not 10 years away from it, but at some point here in the next 5 to 6, 7 years, I'm going to get $2 to use. So if I bring in, say, $1 million this year, and I only need to live off, a couple 100,000 of that, but in 10 years I run $1 million through it and I get $2 million to go put to work. Yeah, I'll take that Pepsi challenge against anyone any day.
That's awesome. Hey, by the way, so people have been asking a lot about, like, hey, how can I learn more? Start with the book. Like Nick and Jim are so graciously offering to get that for you guys. I want to encourage you to do that. They have great resources on their YouTube channel. I want to also offer Wealth Without Wall Street has an online community that you can join for free. You can find it on the App Store. If you go to the App Store and just search Wealth Without Wall Street, or you go to community.wealthwithoutwallstreet.com, get a free access to that. And there's a course in there called IBC 101. So if people want to go deeper into some of this stuff, there's also a level up that's like IBC 201. And I think that's $39 a month. So just full disclosure, there's a charge for that, but the other stuff is all free. And what I would encourage you to do is dig deeper into some of these resources and then get set up with the coach that you need to work with. Nick is right there in your neck of the woods. He knows his stuff. Obviously, he's doing this at a high level. The coach is far more important than the company that you're working with. Like, you see some people talk about Northwestern, or was this company better? Is this company better? The company that's the best is the one that your coach knows how to set you up for success with. And you guys are real estate investors. There's some really creative things that Nick can set you up with to get you access to your capital today, that you don't miss a beat in terms of getting out there and getting your deals done. So hopefully that's helpful. Get some of these access to these resources for free, and then get with a coach ASAP, because this is the time you need to have your powder dry and ready to roll. And this is, you're going to wish you had done it 3 years from now if you don't stop and do it now. Just, you always wish you had done it earlier. So that's my
Isn't that funny? Yeah, thanks, Joey. You know, isn't it funny? You probably hear this like we do all the time. People are like, "Oh man, I wish I would have known about this when I was 20. Man, I wish I would have known about 10 years ago." But here's the thing: it's never too late to start doing the right thing. And
That's right.
you know, we've got clients that like everyone else does that are in their 70s and 80s, and there's strategies to play there without a shadow of a doubt. I mean, people are watching what's going on in Wall Street right now, what's going on with the government and how they're handling money, and they say, "Hey, I want to get that off of the radar." We got a great book called Tax Invisible, where a Silicon Valley guy had $100 million, and he, over the course of 10 years, put $10 million a year in there to get it into the tax shelter. So, you know, if it's good enough for people to have that type of money, well, then I'm paying attention, because like Tony Robbins says, find somebody that's got what you want and then go learn what they did and replicate that. Like, I'm not willing to do what someone, you know, making just a couple of bucks is doing. I want to go learn from people that have done it. So
Yeah, no doubt.
You know, Nick, think about that guy.
Earlier, I think it was Jim or Nick. The people making the policies for our government are the same people using these tools, and they're not going to hurt themselves. Like,
that's right.
So just remember that. It's really important. And, I mean, and that's true about just all real estate. I mean, like, just remember it.
So think about the guy in the Tax Invisible book that Nick was talking about, the Silicon Valley executive. He was in his 30s, and so he's going to put $10 million a year in for 10 years. And at 65, he can take out $14 million a year from that policy. Okay. And now think about that. If that's all the money he has, now we would feel sorry for him, right? I was just kidding. But if that was all the money that he had, he wouldn't have to file a tax return. He has no reportable income.
It's all alone.
Right? And he would probably qualify for government benefits. He'd be getting that check that the government's going to send out.
Ham and cheese.
Yeah.
Yeah.
So to wrap us up, I don't think we're going to have the chat when it goes up on. So Nick, do you want to just give out your email and contact information so that way people can write it down when they're watching the YouTube? Yeah. So it's you can find me a couple different places. One is Nick Kosko, NickKosko at CreateTailwind.com. Or you can go to CreateTailwind.com. You can register for a meeting on there. I've already seen, I don't know, I feel like I got a dozen emails that popped up on my phone from people already doing that. So you can hit us there, or I'm on Twitter at Nick Kosko's on there, or we have a Facebook page. Create Tailwind is on Facebook as well. But if you're into listening to podcasts, we've got the Breakaway Wealth podcast. And so I put a link to one of those. Jim was talking about the life insurance contract. We recorded one called the 10-minute lesson life insurance. I put that in the chat on there too. So anyway, and then last thing is YouTube. There's a Create Tailwind channel on there, which guys, a lot of videos. It's a lot of the presentation. If you're wanting to go back and see some of that, a lot of the presentation plus some bonus videos on there too. Thanks, Rob. Once again, thank everybody for coming. Thank you, everyone who came on. Joey, Jeff.
Thanks, Rob.
Luke Neubauer.
Thanks, guys.
We'll probably have Luke back on to talk about Airbnb in the next coming week or two. I'm sure he's agreed to it. But I thank you for coming to this most different one we've had so far. We'll probably get back to a little bit of the norm. But if you like this, we can do stuff like this anytime. The world is our oyster. We've got free time. We're sitting at home. Thanks again. Once again, this is all our own opinions, nobody else's. Next week, we'll see you Monday at noon. We'll send out emails. Thanks, Lauren, for editing. Eric, George for editing. And you all have a great day. It looks pretty. Enjoy the weather.
Yeah, thanks, Rob. Thanks, Luke.
Thanks,
Joey.
Rob.
Jim.
Good to see y'all.
Thanks, guys.
Thank you, guys.